Good day to you from New York. My name is Dr. Leon Perlman. I'm at the Columbia Business School at the DFS Observatory as part of the Columbia Institute for Tele-Information. I want to thank you all for joining us for yet another one of our webinar series. Today, we're going to be talking about an incredibly important topic, a growing issue of de-risking, and we have two superb speakers, Andrew Lucas and Tracey Turner. Just some housekeeping notes. Please switch off your microphone and video, please, and I can see that all you have. Thank you for that. We're going to have Q&A after each presentation, but please do not ask questions via audio at any time because it disrupts the speaking. And you'll see a chat box on the right-hand side, depending on how you've configured your computer. So send questions towards the end of each presentation to the moderator, that's me, or Michael, you'll see, or Jason, via the chat box only, please. So a little bit about the DFS Observatory. We've been around since early 2016, funded by the Bill and Melinda Gates Foundation. There's our website if you haven't been to it. Excellent resource on everything DFS, and in fact, all our webinars and conferences are available there as recordings, and you can play them at any time. There are also some quizzes, so you can test your knowledge of each webinar, for example. List of publications. We had published 12 publications at the end of December, so I encourage you to take a look at those and download. And of course, the legal library, legal and regulatory library, which is updated now 800 documents from close to 60 countries. So it's there and it's free. This is the team at the DFSO, Professor Ali Noam, the director, Mike Weschler, Jason Buckweit, myself, and Sergio Miles joined us. Here's our first speaker, Tracey Turner, Senior Analyst for Global Center. Tracey is well known in the de-risking space. She specializes in financial inclusion issues, including AML, and countering the financing of terrorism and bank de-risking. She focuses on the Greater Horn of Africa region in particular, and authored a lot of excellent reports which we use on de-risking. In fact, let me say that the DFSO is busy putting together a publication on de-risking, which should be out in a few months. Tracey holds a BA in International Affairs and Political Science from Northeastern University, and she's based here in New York City. Andrew Lucas also joins us here in New York City as Director of the Office of Financial Innovation for the New York Department of Financial Services. He focuses on virtual currency regulation and cybersecurity examination, both equally hot topics. He was an attorney in the Legal Counsel Division of New York City's Law Department, which provided counsel to various agencies, including New York City Cyber Command. He's previously litigator of the City of New York. And that's myself. You can look me up online or on the DFSO website. And with all that, I'm going to now hand over to Tracey Turner. Again, if you want to send questions, please do so in the chat box. So we have questions teed up, Tracey. Over to you, Tracey.
Great. Thank you, and good morning or good afternoon, everyone. Thank you to Columbia and to DFS for hosting us here today. The focus of the webinar, as we know, is on de-risking. So I'll start a bit with the basics. What de-risking is, who it affects, and why it matters. We'll talk a bit about some of the drivers and factors and examine the current state of play. And then I'll offer some thoughts and insights on maybe where we can go from here. Too far. So first, I'll talk a little bit about who I am and kind of why you're here listening to me today. The Global Center on Cooperative Security is a nonprofit organization. We have offices in New York, DC, and London. And we do context-specific research, in-country capacity building, and policy guidance and advocacy. We focus primarily across most of Africa, but also North Africa and the Middle East, South and Central Asia, Southeast Asia, and the Caribbean. And our work is focused on 4 areas. We do work on preventing and countering violent extremism, criminal justice and rule of law, multilateral security policy, and financial integrity and inclusion. And within financial integrity, that includes both capacity building on anti-money laundering and countering the financing of terrorism, I lead programs in Uganda, Kenya, Tanzania, and Ethiopia, and the Global Center also has work in Djibouti, Jordan, Lebanon, and Iraq. But we also look at the broader issues related to financial access, economic empowerment, and equitable development and economic justice, particularly how those things contribute to peace and development and reduce vulnerability to violent extremist recruitment. So that's how we came across the de-risking topic. And in 2015, we authored a report with Oxfam that looked at some of the early drivers right as the topic was emerging on the international space. So what is de-risking? There really is no universal definition, but it's generally understood as when financial institutions seek to avoid risk rather than managing or mitigating it for particular categories of clients. To do this, banks either exit relationships or close accounts, restrict the types of businesses or services they'll offer, delay or reject transactions of a client, or in some cases, deny financial services to them entirely. In terms of who's being de-risked, it's been shown to affect nonprofit organizations, correspondent banking relationships, and money service businesses. And there are kind of two key things to note here. The first is that it is whole-scale denial of services to entire categories of clients. In other words, it's not closing the account of one particular nonprofit, but closing the accounts of all nonprofit organizations or those operating in a particular area or on providing a particular kind of service. The other key point is that it is a matter of perception. De-risking is almost a misleading term, as it really only reflects one side of the story. It's the banks. The banks perceive these categories or these types of clients to be high risky. And as private sector entities, that's entirely within their right to determine whether or not they can engage with clients and can effectively manage any risks they may present or are perceived to present. But the issue is that they're not evaluating the risks of individual clients. But again, it's a decision across an entire category or a perception that the inherent nature of a particular type of business is too risky. And this runs counter to what is known as the risk-based approach, which is an international standard set by the Financial Action Task Force related to AML-CFT. And basically it says that each country and each business should conduct a risk assessment to determine its unique threat profile and to calibrate responses accordingly. So I'm going to start briefly with correspondent banking because that's an area that has drawn a lot of attention and for good reason. I know that some of you might be familiar with what it is exactly, but for those who aren't, I'll give kind of a quick primer. We typically think that the international financial system is this big interconnected network, and while it certainly is, at the very transactional level, there are a couple of things that make a difference for particular countries. So each country has its own payment system, and typically only banks that are regulated and licensed in that country have access to it. A correspondent bank is a bank that's authorized to provide services for another bank in a different country. Suffice it to say, they serve as the bridge between the sending and the receiving country payment systems. And that enables money transfers, business transactions, currency exchanges, and all types of international trade. Correspondent banks are especially important in places that are largely disconnected from the international financial system. So in places that don't have a large number of international banks or don't have high bank penetration rates. In those places, they in essence provide a lifeline to the international trade and foreign financial markets. So what does de-risking look like? Globally, there's been a decrease in correspondent banking relationships. Recent reporting from the Financial Stability Board shows that active correspondent banking declined by about 15.5% across all currencies between 2011 and 2017. This was most pronounced for US dollar transactions, which declined a total of 23% in the same time period. An earlier survey by the World Bank found that almost half of the emerging market and developing economies that they surveyed were experiencing a decline in correspondent banking services. Areas that were particularly impacted were the Caribbean, East Asia Pacific, Eastern Europe, and Central Asia. Interestingly, the volume and value of transactions conducted through correspondent banks, specifically through the SWIFT system, have risen in the same time period. And the FSB notes that there's a growing concentration of correspondent banking relationships. In other words, the same set of banks are the group that are offering those services. So it's possible that the uptick in the number of transactions we see is a response to this. As there are fewer banks that provide this service, there ends up being more links in the chain in order to get the money from the sending to the recipient country. For nonprofit organizations, a survey by the Charity and Security Network found that 2 out of 3 U.S. organizations were experiencing financial access challenges. 15% of them had regular issues, and 31% occasionally ran into problems. Most commonly, it was a delay in a transfer, an increase in fees, or unusual requests for information. Smaller organizations were more likely to experience those challenges, but transfers to all parts of the world were affected. So it was not just NGOs operating in conflict zones or in places affected by violent extremism or terrorist presence. For remittance companies or money service businesses, the World Bank survey found that 28% of operators had lost access to their bank account, and a further 45% of agents, so those people actually operating at the point of sale, had experienced financial access challenges. And of those, 26% were no longer able to conduct their business through foreign banking channels. Both of these are, again, correlated with correspondent banking. Some banks indicated that their correspondent bank was pressuring them to close an MSB account. In other places, the loss of a correspondent banking relationship meant that the transactions could no longer be processed. So what does all this mean? The reduction in correspondent banking relationships is problematic because it reduces competition. There are only a few banks who offer these services. It means that there's a chance that the prices go up. And further, it creates a more fragile network, as the failure of one actor could have larger and larger impact on the market as a whole. And competition aside, the reduction in corporate banking relationships runs the risk of cutting off domestic markets from the entire financial system. So for example, in places like Ethiopia, where there are no international banks, the loss of a correspondent banking relationship has really significant impacts on their ability to conduct international trade and access the international market. For nonprofit organizations, the impact is often really easiest to see because it's tangible. Without financing, these organizations are unable to deliver critical, life-saving humanitarian aid. And because of those immediate effects, civil society organizations are unable to address a myriad of other issues, from health to civic engagement to peace building. And this is particularly true in countries that are suffering under an active terrorist presence, where restrictive countering the financing of terrorism laws don't reflect the realities on the ground and often provide an impediment to delivering principled humanitarian assistance. Further, research by Duke Law found that derisking has had disproportionate consequences for women and women's groups, who are often more economically marginalized and financially excluded to begin with. And finally, for remittances, they're a lifeline for people who are in developing or conflict-affected countries. The World Bank estimates that remittance flows to developing countries reached $528 billion in 2018. In 2016, remittances were more than 3 times the total amount of development aid. And in places like Somalia, remittances are more than development aid, humanitarian assistance, and foreign direct investment combined. Remittances are considered so important that reducing the cost of those transfers from 6.9% to under 3% by 2030 is a global target of the UN Sustainable Development Goals. Remittances often serve as the only affordable or available form of financial services, so reducing their access or increasing the cost means the financial exclusion of more individuals, which has been shown to have negative effects on overarching financial stability, poverty reduction, and economic development. So now that we understand a bit about what the problem is and what it means, I'm going to talk a bit about why it's happening. So in the wake of the 2008 financial crisis, regulators were taking some heat for perceptions of being asleep at the wheel. And their response was to renew the focus on financial crime, including money laundering, terrorist financing, and sanction violations. And this heightened scrutiny came not only from state and federal regulators, but also from the Department of Justice. And this scrutiny was paired with rapid regulatory change. According to Thomson Reuters, the financial industry has faced 50,000 new regulations since 2008, which amounts to about 200 regulatory changes per day. And let's recall, banks often operate in multiple countries. This means that they're subject to a complex web of different overlapping regulatory policies, different regulators, and different sets of obligations. It can be really difficult for them to keep up with this pace of change. And they're also operating in a very dynamic landscape with new and emerging risks, especially related to terrorism financing. Recent years have seen a change in the nature of terrorism and the rise of low-cost attacks. In those cases, terrorism financing transactions are basically impossible to identify from legitimate transactions. And all of this is further enforced by a growth in enforcement actions, meaning more penalties for being found non-compliant. And that includes record-breaking fines, but even felony charges. So banks look at this from a rational choice perspective. They are profit-minded organizations, and so they are calculating what is in their own best interest. So they started by looking at their risk levels, and central to that was financial risk. From 2008 until 2016, banks were fined a cumulative total of $321 billion for noncompliance. To be fair, this does include fines for their handling of the mortgage-backed securities, but also financial crimes like money laundering, terrorism financing, and sanctions violations. $204 billion of that came from the U.S., and that includes a record-breaking $8.9 billion fine to the French bank BNP Paribas. And there's also a personal liability component that's growing. In the past, enforcement actions typically came as what was called DPAs, or deferred prosecution agreements, where banks would agree to a set of conditions in exchange for avoiding prosecution. But as the shock of these massive, large-scale fines have become viewed as the cost of doing business, enforcement agencies began moving towards criminal prosecution. I have a quote up here that talks a little bit about what it means to have this environment, and we'll circle back to in a second, but the DOJ Yates memo said that individuals would not escape criminal or civil liability for their role in corporate misconduct, including fines and impeachments. That's a memo that came out in 2015, but was reaffirmed again in 2017. So for both financial and criminal enforcements, there are significant reputational risks. BNP Paribas, who again saw that $8.9 billion fine, also saw a market loss of $12.7 billion that was related to rumors over this impending enforcement action. And these actions often require firms to hold more capital, retain liquidity, or solvency, which has an impact on their overall balance sheets. And at the very least, the reputational damage can be career-ending to top leadership. So against this risk, banks are evaluating the reward. The low profitability of a customer base has often been cited as a key, if not the most important, driving factor behind de-risking practices. According to a study conducted by the British Financial Services Authority in 2011, banks surveyed appeared to be willing to maintain clients that appeared to have unacceptable amounts of risks if the proceeds of those clients were sufficient. In this case, money service businesses and NGOs are not the most profitable clients. And in addition, the cost of compliance, so the cost of managing these businesses, are going up. A Wealth Insight report estimates that the global AML spending will exceed $8 billion in 2017. That's up 36% from 2013. Most banks are adding more staff, they're adding new policies and new technologies, and all of that is coming at an increasing cost. And the final consideration is fear. Nonprofits and remittance companies have gotten a bad reputation. Remittance companies were falsely suspected of being associated with the 9/11 attacks. And even though it wasn't true that they were involved in that particular instance, a perception has remained that this is a business model that can be abused by terrorism financing. The Financial Action Task Force called nonprofit organizations particularly risky related to terrorism financing, which created a stigma that still lingers today, despite revision of that language. And in some countries, this is further emphasized by political targeting of civil society organizations as part of a general crackdown on civic space. And banks are also saying that they're scared because they feel the standards are not clear. The very nature of the risk-based approach is to allow flexibility based on unique business models and risk profiles. It purposely does not establish a universal standard. Coming back to this quote that you see here from the Comptroller of the Currency in 2014, to be fair, it is associated with misconduct related to Forex markets, but it illustrates the regulatory environment that does exist and the thing we hear most commonly from banks. And that is that it doesn't matter whether or not there actually is a violation, it matters whether there are sufficient measures in place. So that is inherently subjective. It's within the hands of the evaluator. So that contributes to fear and uncertainty within the financial system, which is something that banks are not particularly adept to handle. They're very sensitive to it. So we've talked a lot about how banks see things, and I want to take a minute to show the other side of the coin. Firstly, regulators have made a number of statements in recent years that say that derisking or wholesale closure of accounts and indiscriminate termination is not within their requirements. Criminal charges are only for the most egregious and deliberate instances, such as banks who repeatedly fail to implement sanctions or conduct cost measures. In addition, there's criticism about those ambiguous standards have resulted in more statements and revised guidance. There's also a number of sectoral forums that are ongoing to help bridge the gap, and the same is true for international standard setters such as FATF. They launched a collaborative process to review Recommendation 8 and to acknowledge the stigma issues. And then we have the debank sectors. And the core of their message is that the humanitarian impact it's having is drastic and undeniable. And that message is really the core of how they're approaching this challenge. But there is also an information gap. Sectors receive a stock letter in the mail that says they have 30 days to find a new account, and banks are not legally allowed to tell them why, which means that the sector is left with little recourse. If they don't know what the problem is, there's nothing that they can do to fix it. And worse, once a client is debanked, it can be harder for them to find an account in the future. No one wants to take on a client that others have found too risky. So the result is what we have here is a situation where all parties are acting rationally, but a problem still exists. In the 2015 paper we did with Oxfam, we called it a market failure. Today, I would describe it more as a hot potato situation. Everyone is acknowledging the situation and the severity, but no one is really stepping forward to take charge. Regulators are repeatedly insisting that de-risking is not in line with their requirements, as you can see by some of the quotes here, but banks are looking at balance sheets and deciding it's not worth it. And the sectors are left trying to meet their compliance standards, but are really challenged to understand where and how they're not reaching the mark. So where are we now? The good news is that our report in 2015 was met with a demand for more information, and government and AML bodies kind of needed proof that this is happening. And since then, a number of studies have come out, some of the data of which I've shared with you so far. And that's led to acceptance. People acknowledge the problem, and the tone is far less contentious than it used to be. As noted, you've also seen a number of dialogues and policy guidance that has been released. But the bad thing is that the problem is still happening. All of the organizations, while the guidance has come out and come forward, it's really made very little impact for them. And worse, we're seeing an echo chamber at the research and the policy level. There are now countless studies and policy briefs about this topic, but much of that is saying very much the same information over the last few years, and there's very little in terms of practical or innovative recommendations. In general, we're stuck. And the ugly part of this, we're shooting ourselves in the foot. By exiting these relationships, we're driving transactions underground. The money continues to move because it's needed. It's a life or death question, but it's just now moving through less regulated channels or through completely unregulated ones. For example, we've heard accounts of planes full of cash arriving in Yemen. We're also losing visibility into these so-called risky transactions. We can't monitor the funds through unregulated channels, and therefore we're losing the wealth of information that financial transactions provide for investigation and intelligence operations. We're not reducing the risk at all, we're just kicking it elsewhere. So why? Why are we stuck? I'm going to offer a couple perspectives, but I do look forward to hearing that from my fellow panelists and from all of you today. For me, I think we're seeing a lot of stick and no carrot from the regulators. They continue to highly scrutinize financial institutions, and rightly so. But while the regulators have clarified the guidance, this has not proven to be enough to recalibrate the market perceptions. The actors are still seen as being too risky with too little reward. Now, government can't compel banks to engage with clients. But policymakers can find a way to incentivize financial institutions to do so. This can either be positive incentives like tax breaks, or negative incentives such as penalties from withdrawing with priority jurisdictions or sectors. Another reason I see a challenge is that we're not speaking the same language. As we've said, impacted sectors are really emphasizing humanitarian effects, but this isn't resonating with profit-minded financial institutions. And while it might seem cold, it is a legitimate question from a business perspective. Banks are being forced to take on more and more responsibility at the front lines of financial crime, and they're also being asked to modify their profit-driven models to benefit social good. It's fair to ask whether or not they are the right actors to take this on. I also think you're trying to fit a square peg into a round hole. So in conflict zones and other developing economies, informal financial systems are the formal financial system. So understanding and accepting the centrality of the so-called informal models needs to be the starting point for the discussion on financial access. Rather than trying to fit these products into a market that was built for a different purpose and in a different era, we need to figure out how to emphasize the benefits of the organic systems that do exist. We need to work from the technology that exists around these centers and build out from there. And there's also a trust deficiency. And this is something that comes up a lot in our conversations. The idea that sufficient compliance in, say, Dubai is not the same as sufficient compliance in the US. And to some degree, this is true. Both countries have different regulatory standards and different laws. But it also reflects an underlying bias. It's that fear that I talked about earlier. Financial institutions just don't trust the sectors that they're banking or the regulatory standards of the countries in which they operate. So where do we go from here? I'll be honest, I included myself earlier when I said that we're stuck. You know, you often hear people say that there is no silver bullet to this challenge, and that is very much true. But there are a couple of pellet guns that we could maybe find. So we need to consider what we're asking and of whom. Financial institutions, like we've said, are on the front lines of the fight against financial crime. And in doing that, we're asking the private sector to become criminality experts. They need to understand a very dynamic money laundering and terrorism financing landscape in order to be able to understand where, how, and who might be engaging in such crimes. And the financial sector is not equipped to do that and is increasingly shunning the responsibility. So we need to consider whether or not what we're asking of them to do is fair, and not in terms of the custody or due diligence requirements or suspicious transaction requirement, but more whether or not we think that the questions that we are asking of them will result in the efforts that we want. So for example, in terrorism financing, is a suspicious transaction report going to actually generate the preventative measure that we think it will? And we need to calibrate narratives. We talked about the humanitarian narrative not moving the needle, but financial institutions do have a role and we need to get them on board. And so to do that, de-risking activists need to consider tailoring their message to the audience. For banks, one option is a corporate responsibility message. You've seen a big uptick on that from major corporations that seems to be garnering some public support. But we also need to be realistic about the extent to which that has influenced core business models of major transactional corporations. It's questionable. In general, it can be argued this is more of a public relations than a guiding business principle. Beyond banks, we should also be tailoring our message towards a host of other governmental actors, looking at the impact on international and specifically commodities where de-risked jurisdictions are predominantly exporting to Western cultures. There's also political arguments about post-conflict transition, reconstruction, development assistance, and security implementations. A third thing we need to do is consider a baseline of capacity. We've talked about the pace of regulatory change, and we need to acknowledge that much of the perceived risk comes from the businesses that are operating in places that are seen to have weak AML CFT regimes. And in those instances, the flood of regulatory guidance doesn't mean anything. It just further complicates and challenges their efforts. They're still trying to catch up to an existing set of standards, and we keep piling more and more on. That's not to say that we shouldn't be refining or revising our regulatory standards, but we need to focus equal efforts on building the capacity of those jurisdictions to be AML CFT compliant. And we need to recognize that this is going to take time. And finally, I think we need to watch and learn from sectors that are experiencing financial action challenges and have found solutions, because they do exist. We touched on a few in our 2015 paper, but the two that are kind of most emerging right now is the first is related to blockchain and digital currencies. FinCEN, the U.S. Financial Intelligence Unit, define these businesses as being money service businesses, thus applying the same rules to them as they do to remitters. And they also suffer many of the same challenges around a lack of understanding of their business model, questions about anonymity, and cross-jurisdictional regulatory frameworks. But the difference is, digital currency is seen as being immensely profitable, and it has the interest in the entire weight of a tech industry behind it. Remittance companies and others can learn from this. They can learn from how those challenges get tackled and particularly build strong alliances so that they can help shape and find tech solutions to regulatory challenges. And the second one that I'll mention, which is always a bit awkward in professional settings, but I think it's a critical issue in the US, is the growth of marijuana banking. As marijuana becomes legal in particular states, there's a question around where and how those institutions can be banked, because at the federal level, it's still considered illegal money. And this includes not only growers and retailers, but vendors, suppliers, landlords, doctors that prescribe it in cases of medical marijuana. There's a big legal risk for banks who are banking those entities, and it can be difficult for banks to understand and navigate that. And here you're seeing some potential legislative solutions in the U.S. There's a couple of bills that are being kicked around that would help address the inconsistency between legal state and illegal federally, and how they choose to manage those risks. It can provide an important mechanism or framework against where we can consider more nuanced conceptions of risks for NGOs, remittance companies, and correspondent banks. So that's a lot to take in a few minutes, but I'm happy to answer any questions, and I look forward to hearing from you all. Thank you.
Okay, thank you very much, Tracey. That's pretty comprehensive. I think you sketched the conundrum that is derisking, or as we call it here at DFS, refusal to serve. So a question from Rory McMillan about mobile money and mobile network operators. He wants to know if they are immune to some degree from derisking because of their proprietary networks.
So mobile money is quite interesting because in many of the places where it's emerging, it sits within kind of a regulatory gray area. Often what happens is that the mobile money operator is being regulated by the telecommunications company through which it operates. And they see their regulation as the bank account that company holds as opposed to the individual operators. So it is another one of those areas that could potentially find itself in a bit of hot water. I think right now the sector itself, because it is very much limited within particular telecommunications companies, hasn't quite caught on to the closure of accounts in the same way. But it will be very interesting to see how that plays out in the future.
Thanks, Tracey. Just one from Shafiq in Jakarta. Could you provide any solutions to de-risking? And also a quick one from Abdul in Cairo. Could you name a global correspondent bank, please?
Global correspondent bank. Okay. So on the solutions bit, I'll be entirely honest with you. I think that's the challenge that we're all suffering. And the way we as the Global Center view it is, again, we've kind of got that hot potato situation. And I think what is missing in this space is an incentive for financial institutions to bank these clients. So there are examples of how government and policymakers have incentivized the private sector to engage with certain sectors, particularly around mortgages and how they encouraged banks to give mortgages to low-income populations or to fund affordable housing in socially needed-based areas. But the question right now is of appetite and whether or not that is a space that the government is willing to show leadership in. And that becomes further compounded by cross-jurisdictional challenges. So it would need to not only be one government, but a host of governments. Global correspondent banks, I think primarily there's a number of them that sit in your international banks, so those that are operating in a number of jurisdictions. But I wouldn't be able to give you a specific one for where you're located now. I think that was from Jakarta.
Okay, great. Thank you very much, Tracey. We're going to now move on to Andrew Lucas, also in New York. He's from the New York Department of Financial Services, and he's going to talk about de-risking from a regulatory perspective. So, Andrew, over to you.
All right. Thank you, Tracey, for that, and thank you, Leon and DFS for hosting. Wanted to talk a little bit about de-risking from that regulator's perspective, and really the idea of managing risk over sort of measuring risk overall. I am the Director of the Office of Financial Innovation for the Department of Financial Services, and that is that's a nice shop that works primarily on sort of virtual currency regulation. The New York DFS has a much broader mandate. It operates under the New York Insurance, Banking, and Financial Services Law, which means we get some view, and it's not a complete view, but we get some view into a number of different areas where de-risking takes place. And I'm going to do my best to touch on a few of those. That includes correspondent banking, money transmitters, and again, what my own shop does, virtual currency or Bitcoin companies, really. And I'm going to try and keep that pretty short. I limited myself to one slide because I know it's kind of niche, but it is related and it fits in. And last, I want to touch on how regulators more broadly fit in with this process and what they can do, and where risk analysis processes can be improved and focused for the entire space. Before diving into the specific industries, it's very important to focus on what I call the regulatory frame, and that's just the idea that different regulators are going to have entirely different frames of reference, and whether you call that their mandate, or it's their jurisdiction, or their enforcement priorities, or simply how they allocate their resources, at the end of the day, your regulator is going to have its own view of what the market is, who is in the market. A federal regulator might have power over the entire U.S. They might have reach even farther than that, but they might be limited to certain types of products. A state regulator might have a much broader group of entities that they license or charter or regulate, but that might be geographically limited, right? And for de-risking, that's important because you have to keep in mind that regulators are always going to be operating with different levels of information available. They're going to be working with different entities. They're going to have completely different sets of visibility into what's going on in the markets. And as we mentioned, different views of what the market even is. And coupled with that, the opportunity to conduct any enforcement action or do any sort of redress is also going to change based upon their legislative mandate or their own priorities, depending. And with de-risking, I think that's particularly important because the regulator is not always going to be directly involved. And when they are involved, what you're going to see is they take what is relative to business a more cautious path in a lot of ways. I think a great example of this came in some early guidance in 2015 from the FDIC, which stated regulatory recommendations to terminate deposit account relationships cannot be based solely on reputational risks. And it went on to say to encourage institutions to take that risk-based approach in assessing individual customer relationships rather than declining to provide banking services to entire categories of customers. And while Tracey talked about how the shadow that regulators cast simply by having people focus their compliance and their risk is important. Absolutely, it's a factor. At least philosophically, I think this is important because it does get right that the regulator isn't there to cut off an entire industry, an entire region, simply based on risk, but it's to encourage a risk-based approach that actually will let individual operators, individual folks, individual businesses assess and properly weigh the exposure there. And so turning to correspondent banks, as mentioned, they're used for a range of different services, and that includes check clearing, clearing and settlement, cash management, wire transfers, and trade. But to give an example in context here, where there's a U.S. bank that has a correspondent relationship with even a parent bank abroad, it will often be involved in whatever transaction that results in that transfer of dollars. But they don't always have that proper window into what the underlying transaction is. And that, of course, can be a problem. If they don't know who is involved, if they don't know exactly what or how many transactions are being processed, if those transactions are batched or aggregated. And knowing your customer's customer may not always be an express requirement, but at the same time, if it turns out that a transaction processed is being processed on behalf of someone who is on a sanctions list, that is a problem. If you are processing batch transactions and they are a bundle of legitimate and illegitimate transactions trying to conceal, again, that is going to be a problem. And so, as mentioned, correspondent banking relationships have been somewhat on the decline. And the interesting thing to look at is what happens as a result of those relationships being cut off. And the World Bank touched on a number of those results, and three of the main ones are the concentration of transactions into really a handful of typically larger banks that are able to allocate additional resources, or perhaps are more familiar with the industry, or perhaps they have other compliance tools they can bring to bear. But there's other points here that are indicative of some of that risk and some of the problems, and whether it's innocent or not, the difficulty in de-risked entities to actually get additional banks. And that is either the race to the bottom, where they turn to banks and banking relationships that are not as closely scrutinized, or wholesale separating from that from the formal banking world and going for informal alternatives, and whether that's cash, whether that would be a virtual currency, whether that would be a commodity or something else. The interesting thing here, and this is a good point to turn back to that legislative frame, or that regulatory frame, is as a regulator, anecdotally, what we see is almost entirely that concentration of transactions in a few of the larger banks that are able to presumably bring more of those regulatory resources to bear, more of those resources to bear, compliance resources to bear, to actually look into the transactions, to figure out who the customer's customer is, to make sure they have appropriate information if there are aggregated or bundled transactions. Because really, when you're looking at the race to the bottom or the informal alternatives, those are essentially ways to get around that level of scrutiny, right? That doesn't necessarily mean that those are not legitimate transactions. It might just mean, as mentioned, that those industries are having a tough time turning back to a bank once they have been deplatformed. But at the same time, they're also not able to go to a banking relationship that does have that additional level of scrutiny. So the driver of declines in correspondent relationships is often often asked as, is it business related or is it risk and regulatory related? And I think ultimately you need to take both together, and they're always going to be related. But particularly with correspondent banks, they're viewed as low margin and high risk activity, and that makes them particularly unpalatable. Tracey had a great slide that I took down. I think it was titled Internal Calculus, that actually did a really nice job of breaking down that thought process. Because ultimately, if it is low margin, banks would still take it on, presumably, except there is the additional risk of penalty, of regulatory scrutiny. There's the cost associated with that, and there's the cost of generic compliance costs with dealing with those individual clients, right? So it's important to note that even where that regulator isn't stepping in and taking a specific enforcement action against one individual in that space, let alone an entire industry, you still see that shadow cast by the by that regulator in terms of compliance cost that does come through. Now, money transmitters are another area that have been money transmitters and money service businesses that have been subject to significant de-risking. And the survey by the World Bank and the G20 indicated that 28% of money transmitter principals and 45% of their agents had lost access to banking services, which is a tremendous amount. But I think the interesting thing to tease apart is the actual difference in what the banks and the money transmitters cite as the reason for this happening. And the banks cited first profitability, pressure from their partner banks, lack of confidence in the money transmitters, and only then reputational risk. The money transmitters cited fear of regulatory scrutiny, reputational risk, and profitability third, with fear of losing partner banks at the end. And I think it's important to take a look, because that idea about the trust or the lack of trust or the communication between the entities really comes to the fore, but so does the actual profitability issue. And the fact that this is in fact a low margin area, even when you're looking at it alongside the other reputational or potentially compliance-related risk issues. But to take a step further, that same survey also asked about the sufficiency of supervision in the money transmitter sector. Money transmitters rated the sufficiency of their supervision in the high 80s. I think it was 87%. Regulators put it at 85%, but banks put it just above 50%. So on average, banks thought, 1 out of 2 banks thought that money transmitters were sufficiently regulated, and attendant to that is sufficiently regulated and could be trusted from a risk and compliance standpoint. And to some extent, this makes sense. The money transmitters have a built-in higher risk profile in many ways. The National Money Transmitter Association gave this illustrative list of that inherent risk profile as working with resident and non-resident aliens, working through agents, working without face-to-face interaction, working by internet, with prepaid cards, and on mobile, working with corporations that may be newly formed and present ultimate beneficial owner concerns, transactions involving the cross-border transmittal of funds, correspondent accounts, cash-intensive businesses using wires and money orders and other more exotic financial products, privately owned ATMs, concentration accounts, and working in high-intensity financial crime or drug trafficking areas and foreign equivalents. So, looking at all these as part of that potential inherent risk profile, you can see why the banks, of course, have their concerns, and they often claim that they derive insufficient profit given the level of risk associated with remittance service providers, according to the FSB. So what's the takeaway? Well, maybe not surprisingly, regulators are in general confident of their ability to assess and work with the entities that they license, and that does include money transmitters. But that actual relationship between banks and money transmitters can be a tougher one. Again, you can talk about that as the sort of a trust differential, but at the end of the day, there is the view that there are many inherent risks built in, that there is perhaps insufficient regulation, even though the regulator themselves, the money transmitter themselves, may feel that regulation is sufficient. And of course, that gets back to the underlying point, which is, for a regulator, the question has to be, how is a business, a bank, whichever entity, managing their risk, and not what is the overall level of risk that they have accepted. That's at the core of that risk-based approach, and that's the only way to move forward with those relationships. And actually, it's worth, before moving on to virtual currency, going back to that FDIC letter from early 2015, because it actually, and I think for a regulator in a fairly brave way, it acknowledged that management of risk and not the overall evaluation of level of risk is very important. It said, that as a practical matter, it is not possible for a financial institution to detect and report all potentially illicit transactions that flow through an institution. And it went on, existing guidance, when an institution follows existing guidance and establishes and maintains an appropriate risk-based program, they generally will not face some of those same regulatory concerns because as a regulator, they could acknowledge that it's important to maintain a well-formed, well-thought-through risk-based approach, and at the same time, you still may not catch everything. Briefly, I wanted to touch on virtual currency, which of course is an emerging technology and had some of the same concerns as money transmittal. Anonymity and pseudonymity are built right into it. Banking relationships were actually incredibly difficult to come by for this entire industry. And that really didn't change, I don't think, until late 2017, early 2018. One major bank reported it took them on average nearly 22 months and 4 on-sites before they were actually comfortable onboarding these sorts of companies. But, and Tracey alluded to this, as the sector has actually grown and as it has remained backed by the tech sector, banking relationships have become easier to come by. But those relationships do remain closely scrutinized, and they are frequently revisited to make sure that they are staying current in their own business model, in who they're working with, and in how they're monitoring their own transactions. So, regulators, of course, influence the actions of businesses by their own focus, by their own guidance. But de-risking in general seems to be a broader business decision that is impacting low-margin businesses. Regulators need to be sure that they help define what exactly the key problems or issues or pieces of risk they want focused on are. And really, that's not in a general sense. That is in disaggregating the actual idea of an area of the world or an entire sector of the economy, because you cannot be that broad. If you want to be managing risk and not measuring risk, you actually need to carefully onboard your customers and do a detailed risk weighting of who they are and what they do. And to do that, you need to understand their business model. Are you going to be seeing them working with agents or through agents? Are there going to be aggregated transactions? What kind of customer data are they collecting? And you will also need to be ready to update and refresh that customer data frequently and based on that original risk weighting from them being onboarded. Obviously, the higher risk weighting, the more often you should be sure that everything you have is up to date. And thorough transaction monitoring. Has there been a change in what or how funds are moving? Has there been a change in who those funds are moving through? I mean, these are the things that should draw some yellow flag and prompt additional inquiry. And with that, I would turn to, I guess, the last and probably most important point. If you are based in the U.S., it is tax day and you need to file today. Please do not forget.
Thank you, Andrew, for that very timely reminder.
I forgot until this morning, if I'm honest.
Okay, press that submit button on your software. Okay, thank you very much, Andrew, for that perspective. And we, not surprisingly, we've got a lot of questions for you, but in the short space of time that we have, we're just going to take one or two. Arnold in Washington, D.C., what are the regulators doing about this, for example, and also the standard-setting bodies like FATF? Well, I suppose when he says, what are you doing about this, it's just to give more comfort to banks or remittance providers that that the regulators have got their back.
Well, again, that's going to vary so wildly based upon who the regulator is and who they're working with. Here at New York, at the New York Department of Financial Services, we work directly with the money transmitters. We license them. So we are involved in their supervision. We work closely with them every day. We conduct examinations. We make sure their processes and procedures are strong and fulsome. And I believe the ones that we work with as licensed entities and well-supervised entities aren't really facing a lot of the same problems. On the other hand, that's part of that same regulatory frame, is when you are talking about, say, a smaller money transmitter that is potentially based in an area that does not have the same the same fulsome compliance processes or regulation built in, they might not have that same advantage.
Okay. Question from Kathy from the US. Are banks generating a larger profit from the virtual currency companies and therefore more interested in bringing them on board than remittance companies? Profit question.
You know, I can't speak to the actual bottom lines, but my intuition would be yes, I think so. Certainly with some of the larger companies, that is what I would expect. Yep. And Tracey alluded to that as well. If there is additional money to be made, if you take out that low margin, that low profit margin problem, then banks seem more willing to work with that industry, that business, and that's why it's still an unfortunate problem for remittance businesses and for NGOs in the same boat, because they are lower margin and they bear some of the same risks. Initially, when banks were just sort of finding out, really, focusing some attention on virtual currency businesses, there was a lot of the same concerns, and bluntly, a lot of the profit wasn't there either, and they faced the exact same problems as well.
Thanks, Andrew. Question from Camiso in Johannesburg. Is there a possibility of safe harbor for banks?
Well, I certainly don't have the power to grant it. Let me say this, and this is why I kept going to that FDIC letter, is I thought it was a really powerful philosophical statement about where regulators should have their head, as much as an actual statement on providing bank services and guidance. They explicitly recognized that if you have fulsome existing risk program, that you're in that way able to. They recognize that you're not going to catch every violation that comes through. You know, there might still be some illegal activity going across. That said, again, if you have the right programs, if you are carefully and continuously evaluating these customers and weighting them by risk, so you're reevaluating the right customers, then the implication there to me is some sort of informal, or at least an eye towards something like a safe harbor. Absolutely. Leniency, maybe. Maybe that's the word.
Somewhere along the continuum, I suppose, but something more than we have now. We've got time for one quick question, if you could, because we're close on the hour. From Maleki, I'm just wondering if it's possible to align the differences in perception of the degree of regulation of money transmitters, so at the end, financial institutions are given some degree of confidence in doing business with it.
Well, I think there is, and I actually think that is probably one of the places where regulators do have a very serious role to play in actually communicating what sort of specific risks, what sort of specific things banks should be looking for when they are both evaluating and working with money transmitters. I think the more that communication can take place, I think the better the opportunity for banks to feel more comfortable and to feel comfortable with the level of supervision money transmitters are subject to as well.
Okay, great. Thank you, Andrew, and thank you, Tracey, for a lively discussion. We're getting some very good comments in the chat. And just to say, the recording will be available in about 10 days on the DFSO website, dfsobservatory.com, and you can listen to it in your own time. Our next webinar will be on May 9th on Introduction to Payment Systems and on Faster Payments by Dr. Brad Pragnell. We'll be sending out logistics for that in the next 2 weeks or so. So, again, thank you everybody for joining us from around the world, and it's been a very lively discussion. We've obviously had a lot more questions that we could cover in a short time. But you have Tracey and Andrew's contact details if you need them, and reach out to them through us or directly, and I'm sure they'll be able to answer your questions directly. So everybody, wherever you are in the world, if it's late night, good night, and good day to the rest of you. Have a great day wherever you are in the world. Goodbye from New York.